Sound of Money with Santosh Sirur.
Hello and welcome to another episode of The Sound of Money. And once again, we have our special guest and we have Tejas joining us once again, Tejas Gutka, who is basically from, the Tata Mutual Fund. He is a fund advisor there. And we have been having him on our previous shows. When we spoke last, Tejas spoke to us about investment horizon. Basically, how does one go about with investments and, what kind of advantages one has possibly when one starts investing early in life. So let's welcome Tejas first on the show. So hi, Tejas. How have you been?
Hi, Santosh. Been very well. Yeah. Thank you so much. It's a pleasure being here again.
Sure. Thanks. And thanks once again for joining on The Sound of Money. So Tejas, my first question to you actually, and as we were discussing pre-show, we're going to talk about this concept of float. So can you share a little more about what exactly is this float all about and how is it related to a common man who is really into investing?
Sure. So, float is basically this concept that, float is money that you have today, but you don't own it. So it's basically money that you owe to someone, but you owe it, far away in the future. So it's like a interest-free loan that you hold today. Let's say, hypothetically speaking, that let's say you have to travel to a foreign land for work, and you're going to be away for 5 odd years, and you have a lot of physical gold that sits with you, and you don't trust your relatives or the bank to safekeep that gold. So you lend that gold to me and you say that, when I come back after 5 years, give it back to me. So now I'm sitting with this lot of gold that you've given me. What I could do was use that loan as collateral. So give it to the bank, either earn an interest rate on that gold for about 4-5%, or I use that as collateral to do something. So long as I don't lose the principal, which is the value of gold that you've given me, I'm making a return on that money, which is very high. So while the rate of return is about 5%, to me, it's 5% on zero capital. So, the return is very, very high. So without actually putting in any capital, I'm making that money, right? So that concept, that gold to me is float, right? It's basically money that I don't own, but that I have with me right now.
Okay.
From an accounting perspective,
Sorry, carry on.
So it's treated as a liability from an accounting perspective, since this is money that I owe to someone. But I think used it the right way, this could actually be an asset. And while we spoke of a hypothetical example, it's something that we come across in our real life as well, right? So if when we buy insurance, right, what are we doing? We're paying premium. We pay premium for 5, 10, 15 years. This is premium for our life or our health, right? And we don't claim every year, right? You kind of pay a premium for 10, 15 years and your claims actually happen 20, 30 years down the line. So the insurance company that's, to whom you pay these premiums is basically using this float to invest in the capital market. And that's how they make money on it. And that's how they insure you for your life or for your health, right? So that's the business world example of what a float actually is.
Yeah. In no wonder, right? Insurance companies have a lot of stake in different companies in India and elsewhere.
Absolutely.
Yeah. So are there any examples you can share where there are businesses which use this quote unquote float and to the maximum possible extent?
So like I said, insurance is the most common and the most well-known example. I think Warren Buffett has spoken a lot about it, and therefore it kind of a very well-known example. But if you think of any business where you are prepaying for a service that you will receive in the future, you are creating a float for that business, right? Think of prepaid cards, right? When you buy these gift cards from banks and then you gift it to someone, right? That is floats that you're providing to that bank, right? The most overused example of float could be something like Starbucks, right? We all use the Starbucks reward card.
The card.
So you pre-fill the card, and then every time you're buying coffee, you kind of swipe that card and you get rewards, right? So essentially what you're providing Starbucks is float, right? You're giving them capital that they can use for growth while you kind of claim the rewards that you have when you buy that coffee, right? Something that's very new, in the world today, digital wallets, right? When you prepay a wallet and then use it for payments, that's again float, right? So you're kind of creating float for a lot of these businesses when you prepay them for a service that you'll use in the future, right?
Okay. You mentioned about Warren Buffett, and I guess he's one classic example of how he's made money using the float concept. So anything that you want to share about what he has done really and really been there where he is today?
So there is the investing world kind of thinks about Warren Buffett, and there's a section that thinks that the float kind of helped him create, the wealth that he did. Well, I think that is partly true. I think you can't take away from him the investment acumen that he had to use that float in the right way. In fact, I think he introduced this concept of float to the world. So he was the first one to recognize that, insurance businesses get these premiums, and then they don't have to pay back their premium for multiple years, and therefore you could use them as an investment vehicle. So he's used that very effectively to create wealth, right? Today he's amongst the top few rich people in the world who've kind of done that by investments and not by actually running a business, right? So so that's what he's done, and I think it's something similar that we as individuals also can do, and that's a principle that we can use in our own life to create our own retirement wealth or retirement corpus, which is the end goal of all the investing that we do. But I think that's a concept that we don't appreciate completely. So let me try and explain to you. Right now, see, again, going back to the concept of float, right? It's an income that a business earns today for an expense that it has, or for an obligation that it has to meet in the faraway future, right?
True.
So it's very similar to our own cash flows, right? We earn an income every month, which is in the form of salary or profits from business or whatever that we do. And then we have some expenses to kind of meet today. And then we have a lot of expenses for which we save for in the future, right? Yeah. So in a sense, the income that we earn, or the savings that we do out of the income that we earn, is essentially a float, right? It's something very similar to what an insurance company does. But where we differ is that we don't really give a lot of mathematical thought to this float that we own. So insurance companies, when they earn premium and when they have expenses to earn that premium, they pay a lot of attention to these expense ratios, right? Which is, what are your operating expenses to the total premiums that you earn in a year, right? It's something that we pay no attention to, right? We earn and then we spend, and then whatever we save after spending. But insurance companies work the other way around. They are constantly trying to bring their expense ratios down so that they have more that they can invest, and thereby increase their return on equity and improve their profitability profile. I think if we were to adopt, as individuals, if we were to adopt this principle and we were to work on a ratio which is called our savings ratio, which is basically, you say that how much of my monthly income am I saving? Now in the initial years, like any business, you have a lot of expenses, not enough income. So when you start off, you may not have a high savings rate, but we should all aspire to have a very high savings rate as we move up the ladder, the corporate ladder, or as our businesses grow. And if gradually we can increase the savings rate, we kind of sit on a very large corpus that we can then invest to create a retirement corpus, and which is again going back to this whole principle that we were discussing last time, that while we pay a lot of attention to the returns that we can make on our investments, there are a lot of inputs that go into that future value equation, which is present value into 1 plus rate of return raised to the number of years that you invest for. And I think these variables don't get enough attention. I think float is one way to think of this variable, whereby you can increase the present value of your savings, and thereby, even at an average rate of return over a long period, you could actually create a very sizable corpus for yourself, right?
Okay. Yeah, there was a lot of good feedback from our first episode where we did speak about investment horizon, and one of the feedback, rather the question that came in is, hey, I am now into mutual fund investing, but looks like I've missed the bus. So ones who and for the listeners who haven't been able to catch up our first episode, where they just spoke to us about the Jack and Jill example, where Jack goes on investing, really actually much later in life, but Jill actually invests right from day one. Of course, the difference is that she invests a lot lesser, whereas Jack investing much more. But end of the day, it's Jill who wins it, because she has been investing consistently, even though less, but for a longer period of time, right? And that's how it is. So Tejas, if you to go back to that example, and when we have questions from our listeners who say, have I missed the bus? What would your message be?
Yeah, well, I would say you haven't missed the bus. It's never too late to start, and I think just as last time, let's look at some of these numbers, right? So let's focus on the float first, right? So let's say there are two individuals who start working at the same age. Let's say they're both 25. They retire at the age of 60, so they have a long career in front of them. Both of them start with a salary of, let's say, 5 lakh rupees, which grows at about an average of about 8% every year. Both of them start with a savings rate of, let's say, 10%. So 10% of their annual salary is what they save. Where they differ is that every 5 years, the first investor, let's call him investor A, he starts every 5 years, he increases his savings rate by 5%, right? So he starts at 10%, goes to 15, 20, and so on and so forth. So at the age of 40, he reaches a savings rate of about 25%. Okay, this is where he stops, and this is where he kind of maintains this rate of savings. The other investor, he kind of increases his savings rate by 5% every 3 years, right? So he's doing it a little faster, and he doesn't stop at 25. He goes all the way up to 50%. So he gets to a point where, at about 50 years of age, he's saving 50% of his income. So for the last 10 years of his working life, he's saving half of what he earns, right? Now, when you look at both of these guys, and if you were to simply plot their savings, you realize that investor A saves about, somewhere about roughly about 2.1 crores over his working life, whereas investor B ends up saving about 3.7 crores. So by making that small tweak in the savings rate, investor B ends up almost 1.8x, with a corpus which is 1.8x higher than what investor A, right? So that's the first point, right? That A, focus on your savings rate, whether you're starting today or whether whether you think you've missed the bus. I think what is important is how much can you save, right? Keep a lid on your expenses. There's in the world of personal finance, there's a term called lifestyle creep, which is to say that every time your income goes up, your expenses also go up to that extent, and that basically upgrade your lifestyle, right? So your lifestyle is eating into your savings, right? Don't let that happen. There is obviously we all aspire to have a better life, so there is a little bit of lifestyle creep that we should all allow, but I think we should kind of keep a tab on that and ensure that we're savings at a very, very good rate. Now what we looked here is two investors who started together at a very young age and went on. Now let's say let's say you're someone who's 35 today and you have no savings till date, and you start saving today, and you start with, let's say, a small sum of 25,000 rupees per month. That's all that you can manage to save today, and you would think that where am I going to go with this, and I'm probably too late. I don't think I'll retire with a good corpus. Now again, the same assumptions, that let's assume that your income is growing at 8%, but your savings grow at 12%, because as your income grows, you tend to save more, right? So your 25% monthly savings grows by 12% every year. You worked until the age of 60, so that is the amount that you save for. Let's assume that you earn only a 10% rate of return on this savings you made, right? No hanky-panky very high rate of return, just about a 10%. You'd be surprised that even if you start at 35 and you go on till 60 with this math, you would save about 2.5 crore rupees, and your retirement corpus, which is the total value of your investments at a 10% rate of return, would be about 7.5 crore rupees. That's equivalent to like $1 million in today's currency terms, right? I mean, $1 million is not too small, and you've kind of started pretty late at the age of 35. So this is going back to the point that I don't think you missed the bus. I think if you focus on the right variables, and if you can keep a lid on your expenses, we can all achieve that. I mean, being a crorepati is not too difficult, right? In India, especially, you think that a crorepati is like a very big milestone that you achieve. I think everyone with a little bit of discipline can actually become a crorepati in one lifetime. You don't need multiple lifetime to do that, right? It's about plain simple discipline, right? So once again, the point remains the same. Don't focus on your rate of returns, right? That's something that you can't control. That is what the market gives you.
Exactly.
Focus on things that you can control, right? What is under your control? How much you can save? For how long can you invest? And for how long can you remain invested, right? Being, while you have a 20-year investment horizon, you also have to ensure that you remain invested for those 20 years and don't move in and out of the market, right? Don't try to time the market. So I think in fact, even
consistency, right, is very important, because when in the current markets, right, with the kind of stock market indices that we are seeing, we again now see guys coming back. Those are the same guys who possibly left the market when we saw the meltdown in 2020. So I think the message is, I think consistency, whatever be that amount you invest, I think it's equally important.
Yes, absolutely.
Tejas Gutka, fund manager with the Tata Mutual Fund. Always a pleasure having you on The Sound of Money. Thank you so much for joining.
Thank you for having me. The pleasure is mine. Thank you.
And well, with that, we come to the end of this episode of The Sound of Money. Hope you've been enjoying and we're learning a lot from this show as much as I'm been. So, well, once again, we can join in on the next episode of The Sound of Money. For now, from me, Santosh Sirur and Tejas Gutka, thank you so much for joining The Sound of Money.
Money with Santosh Sirur.